Today, folks, we're diving down into the highest yielding Canadian REITs. These real estate investment trusts right now are yielding anywhere from 5 to 8%. They are mega cap companies within the Canadian economy, some of them even offering global diversification. Since this interest raising environment took place, we're starting to see some recessionary periods unfold in front of our eyes, leading these REITs to 5-year lows. And if you think we're going to get on the other side of this recessionary period, there's a good chance these are incredible buying opportunities to lock in right now. And I'm going to be taking advantage of one of these REITs that we're going to be discussing. So that's a conversation you'd appreciate. Hit that like button because we'll talk about a lot more before we get into these REITs. With first and foremost, why do I not buy REIT ETFs? I'm such an advocate of ETFs. I own the S&P 500 index, VOO. I've got some SCHD, VYM, those beautiful dividend ETFs, some Canadian dividend ETFs with VDY. But why won't I do this with REITs? Firstly, these are sector-specific ETFs, which means they come with a much higher expense ratio. For example, the Invesco S&P TSX REIT Income Index has an expense ratio of 0.51%. Since inception, it is lacklustered in performance, but with a dividend yield of 4.17%, you can immediately knock off that 0.5%, meaning it's probably about 3.6, 3.7% on the yield, which frankly is too much of an expense ratio to underperform the S&P 500. Look at the Vanguard FTSE Canadian Capped REIT Index, probably one of my more favorited ETFs in the real estate market here, 0.38%, the lowest expense I could pretty much find in a sector-specific REIT ETF for Canada, but with a 3.78% starting dividend yield, you knock off the 0.38%, and it just doesn't seem that appealing. We're buying REITs for high yields. If I'm only going to get 3%, I might as well go and buy a bond or a GIC at 4 or 5%, right? Here's BMO Equal Weight REIT Index ETF starting at 4.8%, which is way higher than the rest of them. The performance has been very nice since its inception, very stable and up to the right, but again at a 0.61% expense, it just really hurts me inside. And the fact of the matter is unlike many other stocks you can buy, REITs are already like diversified ETFs. They already have exposure to dozens of different properties across dozens of different locations, and the only real risk you're taking on is management. If management sucks with managing the debt, if they suck with personal and public relations, the stock's not going to do well. But luckily, that's why we're focusing on the mega cap companies, because these are the REITs that already made it, and it'll minimize some of the management risk. Now, before we talk about these high yielding REITs, let's talk about the ones I currently own, with RioCan Real Estate Investment Trust yielding 4%, which luckily is only down 7% year to date, with the dividend, well outperforming the S&P 500 on the year. Keep in mind, 5-year performance is a little less than stellar. Same with Smart Centers. This one's yielding 6.7%. I mean, these two REITs, I think, offer some of the greatest development and current exposure to like mall and outlet kind of retail focused properties with things like Walmart. They got Home Depot in there. You're talking about banks and telecom providers. It's very likely that you're going to their properties when you're shopping at many of the shopping centers. Plus, RioCan building some of the most premier properties in Toronto, these new cities in the skies, I like to call them. They're like condos with malls in the bottom, offices in the middle, and the apartments at the top. These things I think are truly going to print in the future, but keep in mind they're all trading down, and they are going to start seeing risk as the interest rates start to affect their bottom line balance sheet, cutting some of the free cash flow. Now, that's just some of the pain we're going to have to experience with REITs. But again, I think that's going to subside sometime in the future. And currently, I hold about 10,000 of each of these REITs, so 20,000 invested between RioCan and Smart Centers with a drip set up. However, I am looking to scale these down slightly and start allocating to maybe 5 or 6 REITs in total. I am going to be paying myself from my corporation at the end of this year, and I will be looking to add some of that capital to these really high, juicy yielding REITs, because I do like tracking this income as a backup resource to my unstable job. And if you guys want to offer some stability to my life, feel free to help the channel out by going to portfoliospreadsheet.com. If you are a dividend focused investor, you like tracking your dividends, I made spreadsheets specifically focused for portfolio and dividend tracking. These things operate on iCloud numbers, Google Sheets. We're damn near going to drop one on Excel very soon coming into the holidays. I do all the patches for free. You get email updates, all of it for the price of $12.99, a one-time fee with no data tracking. So consider supporting the channel. You want 30% off, use coupon code DIVIDENDS. But let's get into this with first and foremost the numero top of my list REIT that I'm finding very intriguing to follow this year, and that is Slate grocery REIT. Now, though this trades on the Canadian markets, it is primarily a US focused REIT. And we can see that it doesn't really show a yield because it's on the US side of the border. But hey, we go into Yahoo Finance. We take a look here, guys, and we're looking at a starting yield of 7.24% outperformance on the year with 5-year very stable price action within this chart. Now, if you've never heard of this REIT, it's fairly new to me as well, and it's because I've never really stumbled upon it until I saw it as an outperformer this year with 121 properties, 24 states, and 15.6 million square feet, primarily focused in grocery store Encored assets, with 6.5% of their tenant basis being Kroger, 5.2% Walmart, and you can see some of the other tenants here with 35% being supermarkets and grocery, which are super stable. Let's be real. 4% necessity-based and daily needs, 6% medical and personal services, 5% restaurants, 3% institution or financial institutions, 2% dollar stores, 2% liquor stores, 1% pharmacies. You're not really going to go wrong with this REIT. And just taking a look, guys, from like a dividend standpoint, is this thing safe? Well, when I take a look at the adjusted funds from operation at about 14.59 million, I guess coming out of Q3 2022 with the dividend declared of 13.2 million, it looks like they do leave quite a little bit of leeway, and they've been having no problem affording that dividend through this tumultuous market. And if you take a look at the AFFO payout ratio, it's actually been decreasing quarter over quarter. They're down to 90.7%, which offers a little more confidence in the dividend in and of itself, which feels really good. Now, Northwest Health Properties, this is one I've been having a hard time wrapping my head around because this one is absolutely being affected by the interest raising environment with an 8% starting yield, now trading around $9.93, and is starting to hit some of those pandemic lows. Let's dive down into this because this is a globally diversified healthcare focused REIT with 89 properties in North America. You got 64 properties in Europe. You've got 76 near Australia here, and in Southern America, guys, another 8 properties, I think more or less focused in Brazil. What a crazy diversified real estate investment trust. Now, taking a look at one of my biggest concerns, we are seeing actual revenue from their investment properties growing, which is very nice. But what I wanted to look at is the mortgage loan and interest expenses. They have pretty much doubled over last year, going from 22 million to 40 million, and on the 9-month ending from 68 to 98 million. That is extremely painful and something that you're going to want to analyze much deeper. Now, they can still afford the current dividend, but that's something that could get pressured depending on what happens moving forward. So though these are much higher yielders, they do come at risk of seeing some dividend cuts if management did not properly handle the debt and they were focused on too short term of loans. That could really come back to bite them in the ass. But Northwest Health Properties, I still think, is a very fundamental REIT, and even if it did cut the dividend, it would still likely be well over 5%, and you're getting it at a much more reduced price from where it currently has stood. Now, let's talk about some of the industrial REITs. Dream Industrial is one I've been eyeballing for a little while. 5-year performance has just been stellar. Year to date has fallen off a cliff with a starting yield of 5.72%. And if you've never heard of these industrial REITs, they became very famous because they were probably the best performing sector in REITs, pretty much in the US and Canada through the last few years. They become a real marvel. And just take a look at the properties under management here. The list is just jaw-dropping. So these are mostly logistic REITs, things like related to Amazon, shipping, warehousing, logistics, things of that nature. And this list is just astonishing, jaw-dropping. I mean, you're getting a lot of diversity from a company that has a total number of assets that increased for the last quarter from 239 last year to 258 this year. The occupancy rating at 99%. And the bottom line assets, even in this tumultuous market, continue to grow, with the net rental income going to 71.9 million from 59 million this time last year. And just taking a look at the dividend, I mean, their funds from operation diluted was 22 cents. The distribution was at 17 cents. So, I mean, lots of room and security with this dividend, even though we're starting to see the stock get relatively hindered here. Now, let's talk about some honorable mentions, because I think those are of the highest REITs that I'd be most intrigued by. I am intrigued by the lower paying dividend REITs as well, because, you know, some of these do offer much more stability and growth because their dividends might not be as high, but we kind of make it up within the stock performance. And CapREIT makes top of the list here at a 3.28% starting dividend yield. This one is Canada's largest pure play to apartment properties. Stability wise, I mean, the only thing we've seen, even though properties have started slowing down in sales and volume of sales, there's still an explosion in rental prices. And this being a rental focused company, when you see rents go up 20% year over year, this one is going to be cushioned a little bit better probably than some of the other ones when it comes to the rental rates and dealing with the interest raising environment. We got Granite Real Estate Investment Trust, very similar to Dream Industrial, guys, an industrial focused REIT starting yield of about 4.06%. They have a huge Encore tenant. About 30% of their entire tenant basis is with Magna. Comes with a little bit more risk when you're so tenant focused on just one tenant specifically, but they do have Amazon and a few other clients, a long list of other clients that, hopefully they'll continue to diversify away from Magna over time. We've got Allied Properties, your office, condo, and different kind of mixed real estate. This one was very stable coming up to the pandemic, but lately has been hindered dramatically, leading to a 6.41% starting yield. We also have Choice Properties in here, guys, with a starting yield of 4.89%, which over the last year has actually been performing much better than some of the other ones, really kind of coming up off its lows. We have H&R Real Estate Investment Trust is another one with a 4.37% starting yield. Again, it kind of follows in suit with the other ones we just looked at. And there are a lot of other small cap REITs out there. I could talk about like True North, which yields over 10%, but those are much smaller cap. And I'm trying to focus on the billion-dollar market cap REITs because I think that's where you're going to have a little bit more stability and longevity in case some risks come up thanks to the current recessionary environment. But I will pass this question off to you. I'd love to know what you think in that comment section below.